Everybody, we got a busy week ahead of us, and I'd imagine it's going to come with volatility. And what is volatility, you might ask? Well, volatility, there's a couple different definitions it gives us here. But volatility represents how greatly an asset's prices swing. Let's just leave it there. How much they swing. A higher volatility means that a security's value can potentially be spread out over a large range of values. That means that the price of the security can move dramatically over a short period of time in either direction. A lower volatility means that a security's value does not fluctuate dramatically and tends to be steadier. And with where things are, this is the VIX, it measures volatility. With where things are this busy week that we got ahead of us, I'd imagine volatility will not be absent in this market. So let's look at what we got. This is the economic calendar. Monday, we're starting off with wholesale inventories for April. We got a business optimism index, consumer price index. We're going to be looking at inflation. Then right after that, we got initial jobless claims, PPI, consumer sentiment. It's going to be a busy week, but mark your calendars for Wednesday. I believe we even got a 30-year treasury auction on Wednesday, so Wednesday is the day, and be looking at these inflation numbers for May. We're expecting inflation to start getting out of the trend down it's been and start trending up just because of tariffs. You should already know this. And I wanted to highlight something because a lot of people are expecting the summer months of inflation to be a bit higher, while some are expecting the same thing, but even beyond the months of summer. Now, let's look at some reasons inflation could be higher. Let's start off with this timeline. A timeline of Trump's tariff actions so far. And first, let's just scroll all the way down, skip all this mess, and go to April 2nd is where we're going to start off. So April 2nd is Liberation Day. That's where we got these reciprocal tariffs declaring a 10% baseline tax on imports from all countries except China will get 34%, 20% on the European Union, 25% on South Korea, 24% on Japan, 32% on Taiwan. Right there. What did people think was going to happen when we got these tariffs announced? Well, dang, what the heck is a tariff? It's a tax. And what do taxes do? When you're like checking out and you're buying something, the taxes usually make it go from like $20 to $25 somehow. So it increases costs. And everybody was aware of that. So both businesses and consumers were like, well, we got to hurry up and buy before these tariffs hit. But then wait, there's more. Then on April 9th is where we started seeing kind of a trade war happen. So Trump's higher reciprocal tariff rates go into effect on April 9th, hiking taxes on imports from dozens of countries just after midnight. But hours later, his administration says it will suspend most of these higher rates for 90 days while maintaining the recently imposed 10% levy on nearly all global imports. China is the exception. And mark April 9th down because that's when the levies against China went to a total of 104%. Trump said he will now raise those import taxes to 125% immediately. So that's when this trade war started happening. China lifted theirs up, we raised ours up, and then that brings us to April 10th, where we raised them up to 145% right after that. And then China announced that they're going to raise their tariffs on us, and here we are. So then that brings us all the way to May 12th, where we got a rollback where there was a 90-day truce, and they rolled these tariffs back to 30%, and China lowered ours back to 10%. All of this mess, and we haven't even got to the courts declaring the tariffs illegal and then them being back on. That'll show up in later on's data, but April, that gave about a month, and we'll really get to see how these dramatic increases and changes in these tariffs impact CPI. And what you notice is through these different months that we've just went through on this timeline, what we've seen is that tariffs didn't go down, they just went up. So maybe the hurry up and buy started off a little bit smaller around April 2nd, like, all right, prices are going to go up, let's hurry up and buy. and then they went like up on April 9th, and then it's like, all right, let's hurry up and buy some more before this kicks in. Then April 10th, hurry up and buy. Look at these crazy, outrageous tariffs, and it's on both countries, right? The US and China, and those are some of the main partners. And then not even to mention the European Union, another big trade partner, where they were going to get raised to 50%, but it was delayed or something. All of that played into people trying to front run these tariffs. And it takes a while for these tariffs to work themselves out into these inflation reports that we're looking at. So, how much do you think that this tariff regime impacts the CPI data that we're going to be getting on Wednesday? So, we're expecting median forecast for core PCI to come in at 0.3%, which is up from 0.2%. And something to note is that that's further away from the Fed's target. We were getting closer to the Fed's target. It looks like CPI is already at 0.2%. Of course, it's going to be like core CPI was at 2.8, and now it's going up to 2.9. So we're not quite at 2%, and not even to mention the Fed likes watching PCE, personal consumption expenditures, not necessarily CPI, but PCE kind of follows CPI in a way. They both move in alignment. Now, with inflation being possibly a bit more sticky, the Fed's already announced they're not really worried about the job market. They're more worried about inflation, because them cutting rates if the job market gets bad, well, does that really make sense if inflation's already wild? Like that stagflationary scenario that would really be tough to navigate for the Fed and a ton of other market participants. Like, think about a business as to whether they should hire or fire. So it gets a little iffy, let's say. And there are more factors that will be influencing inflation expectations this summer as well, including in summer, it's like it's hot. And what do people normally need to do when it's hot? You run that AC like there's no tomorrow. And people are expecting the US electricity prices to increase, prices to surge 4% this summer due to more expensive natural gas, which is expected to be 37% higher than last year. And hotter summers equal more AC use in both cars and houses, and that just runs the mill, right? And when people expect higher inflation, so they're expecting higher inflation due to tariffs, they're expecting it also because of higher temperatures around the country. What does that normally do? Well, University of Michigan's consumer sentiment kind of told us a little bit about that. University of Michigan's consumer sentiment survey in May revealed that people are expecting a 6% surge in prices over the next year. And when people expect prices to increase, they demand higher wages because of that. And companies can do one of two things. They could, just raise prices. That's probably what they're going to do to offset their costs. Or they could eat the prices. Normally, they're probably going to raise prices. And then what does that do? That increases inflation expectations, and then people demand higher wages, and then companies raise costs. That's called a wage price spiral. And you don't want to get too caught up in the weeds of this happening, because that's when runaway inflation can occur. Also, because of tariffs, companies are expected to raise prices due to tariffs. But there's a fine line between how much they can raise prices, because then consumers are kind of priced out of the market completely and can't really buy. And at the same time, companies with making billions of dollars are expected, like, hey, you're rich, you could eat some of these costs. So it puts them on like this balancing way. And if companies don't necessarily pass on all of their costs through prices to consumers that consumers pay, then if they don't raise prices, they kind of shed off workers to save money if they got to eat these costs. All right, well, we can't really raise prices. How about we cut off some of these workers? And then that impacts the labor market. So watching inflation numbers this week is really going to be important in my opinion, and even the next few reports as they come out. We really don't know where we're going to end up heading. There's a report I was reading, and they were kind of talking about how to invest when everything yields the same, and it's kind of talking about how stocks are near all-time highs, and the expectation of stocks continuing to run is based on earnings, in the hopes that earnings are expected to grow, where it makes these runs the stock market are running on more sustainable or not. So I was reading, and it was saying that investors have to make two calls. First, and here I'm really bad about citing the articles, How to Invest When Everything Yields the Same by James McIntosh. And what he goes on to talk about is how investors have to make two calls. First, our stocks are really worth paying 21 times their expected earnings over the next 12 months, an earning yield of just 4.7%, with 10-year treasuries at 4.4%. So if we're going to compare the stock market to treasuries, the stock market's kind of taking more risk for a little bit more return potential. But in this scenario, according to this article, risk-free treasuries, so it's an IOU to the government, and what's the odds that the government doesn't pay you back? I mean, they could literally just print the money to pay you back if they had to. Treasuries, which are risk-free, are right there with the earnings yield of just 4.7% for the stock market. So that represents almost no margin of safety. The bet is that earnings increase fast to justify the high valuation. Wall Street forecasts more than 13% earnings growth next year and the year after, almost doubling the long run average, and a sharp increase from this year's 9% prediction. The second call that investors make, could it be that margin of safety stocks have over bonds is actually bigger because treasuries now embed more risk? Estimates of the extra yield above future interest rates demand to lock up money in a 10-year treasury, known as the term premium, have fallen fast in the past couple of years to the highest since 2014. This reflects volatility as much of as risk of inflation or default, but it is still a risk. He views stocks as expensive, and so treasuries are a better value in James McIntosh's opinion, but investors have to been taking the other option, leave America, part of what some are calling the Abusa trade, anywhere but USA. And then he has this chart where the corporate bonds, the 30-year treasury, the S&P 500, and the 3-month T-bill are all kind of yielding the same, and which appears better in this case. I mean, like, you think about the S&P 500 expecting to grow their earnings, especially in the face of, we got these CPI reports coming out. This is where all this aligns with inflation. And if they got to keep on raising their costs, I'd imagine that's not going to increase consumers' willingness to go out and buy, and increase businesses' willingness to go out and load up on inventories and hire workers. If anything, it's going to do the complete opposite, and it's going to be real limiting to what people can spend and businesses can spend. So with companies, back to this chart, their earnings yield may not be too good, especially if we're expecting inflation to be a bit higher, while consumers are already kind of getting thinly spreaded as far as what they're able to spend. 3-month T-bills, those could change, and they're only on a 3-month basis. Corporate bonds, you're taking on a little bit more risk because there's default risk. And in the case of inflation, businesses' earnings potential may not be as good. So, I mean, that 30-year treasury, which is pretty much riskless, risk-free, it starts looking pretty good, is the take this article's kind of portraying. They also talk about, back to inflation expectations being a bit higher, there's this article by Shana Mishkin that the apartment glut is ending and demand is rising. Rents are headed up too. And what they're talking about is that the cost of home ownership is pretty high right now, resulting into people deciding to, instead of buying a home, rent a home. And what they're seeing is that because renting, while not affordable, is more affordable than buying, you do see upward pressure growth on rents. And this is according to a Zillow senior economists. The company sees single-family and multifamily rents rising 2.8 to 1.6 this year, 1.6% this year, respectively, while home values are expected to fall 1.4%. This home buying season so far has been a dud, in part because of costs, volatile mortgage rates, and general economic uncertainty. What you're seeing is the for sale side is actually helping boost demand and prop up the rental side, says Rob Warnock, a senior research associate at rental listings and management portal Apartment List. And the buyer's premium, buying a home is now significantly more expensive than renting, which is leading more people to want to rent. And when more people are renting, already there's a what's the word, shortage of supply for homes available. There's not enough homes for as many people are on this planet, right? And there's not enough homes to buy, there's not enough homes to sell. So when we go to buy, to sell, there's not enough homes to rent. So when everybody goes from, all right, I want to buy a home, well, dang, they're kind of expensive and it's kind of looking iffy out there, let's all rent. And when 1,000 other families are doing that and there's like 50 rentals on the market, there's more eyes on these rentals, and the landlords are like, up them prices, baby. More eyes, more prize. So this just leads more into inflation expectations and inflation overall possibly being higher much longer than just these few months, because usually rents don't go down, they just kind of don't increase. Like, inflation is the rate at which prices increase, not go down. That's deflation. There's this other article I was reading, and it's called "The U.S. Economy is Headed Towards an Uncomfortable Summer" by Nick Nick T. And what he was talking about that I seen is that there are three risks loom large right now. First, the U.S. labor market has been in an uneasy equilibrium where companies aren't necessarily hiring, but reluctant to fire workers that they've hustled to find 3 or 4 years ago during the supply chain shortage where they couldn't get enough help. And now it's to where they kind of got too much help, but they don't want to let go just in case. Like, we're holding on to hope. So, like a beach ball that shoots skyward after being held underwater, joblessness can quickly jump once companies decide demand is too soft to keep those workers. It starts with one large firm, then competitors might say, well, listen, we have to do the same. Then the second risk is that consumers could finally push back against these rising costs, forcing companies to tighten their belts. And we're talking about costs already expected to rise between this and next year. And just this summer, not even to mention our home and housing costs are expected to increase, whether you're buying or selling. I mean, buying or renting right now. So it kind of just puts like this chokehold on everybody out there, like nobody's safe. Delinquency rates on consumer debt have been on the rise for a year, raising fears that deteriorated finances for low-income borrowers could lead to a more pronounced slowdown in consumer spending. For the housing market, the spring sales season has been a bust. The U.S. market now has nearly 500,000 more sellers than buyers, according to a real estate brokerage Redfin. That is the largest gap since its tally began in 2013. Home prices could fall 1% this year, according to Chen Zhao with Redfin. The market has been rock bottom for the last 2.5 years, and was some hope that we get a little bit of turmoil this year, and it's just actually been worse than expected. Then the third risk is that financial market shocks or abrupt sentiment changes remain a wild card. The Fed reduced short-term interest rates by 1% point last year, providing a measure of relief to borrowers with credit cards or variable rate bank loans. Something to mention though is that these are more short-term borrowing, like you typically borrow short-term on your credit card or variable bank loans. And then long term would be your mortgages, and typically people will borrow more money long term. And what we've seen is that these long term rates haven't really moved. They're still in the 7% and the high 6%. Officials hit pause on rate cuts this year amid concerns that tariffs might create new inflation risks. Longer term borrowing rates, which aren't set by the Fed and which influence many borrowing costs, such as mortgages, have been elevated as investors around the world pay more attention to how governments will finance rising deficits in the years to come. And what really impacts these long term borrowing rates are inflation expectations. And where are we at once again that we've been talking about this whole video? We're expected to see the inflation data sets that are coming out to be elevated in the months of summer. But the Fed and many others are starting to worry that, hey, this might be a little bit longer than just the summer, and this could be the start of a surge of inflation all over again. Now, does this bring us back to, let's pull up a chart real quick. Let's look up Fed funds effective rate. Now, what we're trying to decide is whether or not this sends us into a cycle that looks familiar, which was back in the 1980s. Now, let's kind of zoom in on this so we could get a little closer look. It was really foggy during this time, and the Fed raised rates, and then they lowered them, and then they had to raise them again. And where are we at? Like, the Fed Paul Volcker ended up having to raise rates higher than the rate at which inflation was occurring. And they had to raise rates over near 20%. I was about to say over 20%. That would have been cap. But let's look at where we're at right now. We've kind of been sitting still. We've lowered 1% or whatever, or whatnot. But what if it gets to a point to where, all right, sitting steady is not enough? All of these inflation expectations are leading to sticky core inflation, which excludes volatile food and energy costs, which people feel that too. Like, yeah, they take it out of these data sets we're looking at, as far as the headline numbers do, but people still feel that. And we're expecting this hotter temperatures, this hotter summer with higher electricity costs to weigh on consumers too, and businesses, because everybody pays for energy. And higher rents. We're expecting higher rents later on this year and into next year. And on top of that, the University of Michigan Consumer Sentiment Survey revealing that many people are expecting a surge in prices of 6% in prices over the next year, and the tariff mess isn't over with. That's still all up for negotiations. We don't know if they're going to go away. We don't know if they're going to still be here just as a different thing, right? Maybe the current way the tariffs are set up doesn't work. It's illegal. So then all right, well, we can't do it this way. We're gonna get it this way instead. Or they are legal, and then this trade war continues, and then tariffs go way higher. So where does that put us with inflation? And that's why all eyes are on Wednesday, because this May CPI data that we're gonna get in, it kind of gives us a tell into what's going on, and then we could just go from there. So everybody, Wednesday is the day. Watch Wednesday. You know I'm going to cover it just like I'm going to cover Monday, Tuesday, Wednesday, Thursday, Friday, then start over the next week, and then the next week, and then the next week. But I'll be here to really talk about what's going on. Hope your week is great, and I hope your day's a blast.